Chad Kopnick here with L. Harris Partners. Today I'm here with two of my colleagues, Mike Metz and Kevin Johnson. Mike and Kevin have years of experience in the CPA world, and they also have great experience in the tangible property area. So we're here today to talk about the new regulations on tangible property. Mike, can you tell me who these new rules might apply to?
Yeah, most businesses are going to find themselves squarely within these new rules.
Okay. Kevin, when do these apply? Is this something brand new? Is this something I need to worry about right now?
This is new, and this is the first time that we're going to implement it for taxable years beginning on or after January 1st, 2014, so this upcoming tax season.
Okay. So if I were planning, what would I need to take care of right away?
Certainly need to analyze the impact of these new rules and how that might impact your filing. I think that the big change in this year will be many taxpayers will be filing a Form 3115, which is a change in accounting method, and there's going to be some elections that you would need to consider.
So if I don't take advantage of this right now, there's potential loss for me or potential penalties for me, Mike?
Yes, this is the first year with your 2014 tax return when the rules will apply. And there are advantages to doing this now. Some of the advantages are deductions that you could be foregoing if you do not apply the rules. And then there's also just the general compliance requirement of following these new rules, which are required rules.
So I've read up a little bit on this, and I understand that we can deduct items that otherwise we've kind of capitalized in the past. Could you, Kevin, explain that a little bit to me?
Certainly, there's items that have been capitalized in the past that, for other reasons, it was something that added value or perceived to be extending the useful life of the property. Now with these rules, it's codifying a lot of the court cases that were out there, and really the rules are meant to kind of reduce the amount of contention around this issue for taxpayers and the IRS. And so there's things that the IRS has now acquiesced to and is allowing to go ahead and expense for tax purposes that previously hadn't been. So we can go back as far back as we can and find things like a roof that may have been capitalized, that now we have a taxpayer that might have two roofs that they're depreciating, and really one has been replaced. That one that's been replaced is something we would look to capitalize on and expense here in 2014.
And if I heard you right, there's no limitation on how far back I can go?
Not on that issue. Yep.
Okay. And that sounds like it means that everyone should take a look, Mike, at their current situation and what's on their books and what's been depreciated or not depreciated, and try and figure out how this applies to them.
Yes, I mean, the areas that you want to look at in your records would be your fixed asset records. You'd want to look at your repairs account and your materials and supplies accounts.
I read about something called the de minimis rule. Mike, can you explain that to me?
Yes, the de minimis rule is something that's very taxpayer favorable, and it allows companies to write off the amount of property that they purchase up to $5,000 per invoice. And if you break out the items on the invoice per item and they're under the $5,000 amount, you can write off each of those items.
And what do I need to be able to write off $5,000?
You need to have a applicable financial statement, which for most companies really will be an audited financial statement. So if you have a review or compilation done, you don't qualify for the $5,000 deduction, but you do qualify for a $500 deduction per item.
Per item. Okay. Kevin, could you explain to me what per item means? Because I think I'm a little fuzzy there.
It certainly goes back to your capitalization policy and how it's written, and so you do need to go back to that source document. And if for GAAP purposes, and that's the de minimis rule is using GAAP as a backstop and saying that if it's a clear reflection of income and GAAP is allowing you to expense certain items, go ahead and expense it. So the per item would be if you have 10 items that fall maybe like $400 each, and so you have an invoice of $4,000. Sometimes that would have gotten capitalized in these for taxpayers. What we can do now is say that each of those items are $400. We can write that $4,000 off as a current year expense.
And if I've capitalized
Just
if I've capitalized that, in your example, the 10 items in the past, the $4,000, would I be able to make that change today?
No, this is a go forward election, and it's a de minimis safe harbor that is going to be in place moving forward. There's going to be a statement that you attach to your tax return every year, and that is how that will get administered.
Well, I guess I needed to try anyway.
Yeah, that's a good try.
Mike, where is this primarily applicable? We mentioned that it applied to most businesses, but where would I find, what kind of records would I need to look at to see if I have something that this might apply to?
Well, where you'd see a lot of the opportunity in past years that you could now deduct this year would be things that you've capitalized onto your fixed asset records. So if you look back at your records and you recorded a building but didn't break out the detail on that, you may have an opportunity to go back and deduct some of the components of that. So for example, if you repaired a roof, or you may find a situation where you didn't write off the original roof, and there's other opportunities such as that. But you'd really want to look at your fixed asset records, understand what detail you have there, and then you may need to go back and look at the backup you have behind that.
So overall, this sounds like a pretty big benefit to taxpayers, that if they were to just turn a blind eye to it, could really turn out to be something they would regret in the future, huh?
Oh, I think so. I think it's really something you need to take a close look at, and really to understand where you're at with respect to what you were doing previously and where you'd be at under these new rules.
Well, there seems like there's a lot of componentry. I heard that these regulations were 150 pages long or something astronomical like that. Have you guys read through all these things and understand them in detail?
Yes, we have. One of the things that the regulations do is they provide a lot of examples, and that's one of the ways to really help understand and apply it to the particular situation you might have, is to utilize those examples. But the regs are long and they're very complex, so you really do need to take a very careful read of those.
So could you tell me how you might look at my business?
Yes, we would really start by getting a good understanding of your business overall and how you go about acquiring property, what you do to improve that property during the course of your business, and then get an understanding of how you're accounting for that today. And then the next step would really be applying the rules to that and looking for those opportunities to get those tax deductions rather than capitalizing items as improvements that qualify for safe harbors or qualify under the rules as deductible items.
Kevin, this doesn't sound like something I should tackle myself. This is something that a professional should handle. Is that safe to say?
It's certainly a tough proposition to go back and take the rules that have been written, and it took the IRS and Treasury 10 years to write these rules, and there were several iterations, and to be able to understand all the different pieces and parts and then applying it to each specific instance, it would be tough, and we would certainly suggest you contact your tax advisor.
So once you guys come in and fix me up, everything going forward, is that determined under some kind of a policy that I handle, or do I need to check in with you on an annual basis to see how this is working?
Generally speaking, once you get your fixed asset systems and your accounting in place, this will be something you'll just continue to utilize the policies and procedures that you put into place.
Okay,
there's definitely an education component to it that needs to happen, and where the people who are updating the fixed asset ledger going forward do need to understand the rules. So that is a component to it, that they are able to then follow those policies.
You know, somewhere I read that there's kind of three categories that this applies to. And it's the buildings and equipment types of things, and then there's this repair and maintenance. Can you explain that to me a little bit?
The primary areas of the rules really are around, is an expense deductible, or are you required to capitalize it as an improvement? So making that determination of whether something is a deductible expense as a repair or is required to be capitalized as an improvement is a big part of the rules. The rules also deal with materials and supplies that you use in your business and whether or not those can be deducted currently. And in many cases, they can be deducted currently. And then the other key area is really when you dispose of property. How is that treated when you dispose of that property? And are you able to take a loss for that?
So it sounds like the new rules apply to situations that I might not have considered a disposition of property in the past, but because the rules clarify things, now that's considered a disposition, and I can quantify that and write it off. Am I safe in saying that?
That would be correct. And there's even partial dispositions. So there might be a case where you've only replaced part of a building or part of a component of a building, and now you're able to go back and historically look at those expenditures and monetize that this year and write it off. And so going forward, that is another election that is made, and it's made by doing, is if you identify something that you're maybe only replacing half of a roof, that would be considered a partial disposition. So you do that in the current year, in the future. Right now, we have that partial disposition of certain components is only eligible up until the end of 2014.
Okay, so now's the time to
Now's
act.
the time to act on the partial dispositions.
Is there a division between a landlord and a lessor that I need to worry about here? So if I'm leasing something and I was responsible for the build-out, let's say, does that become my responsibility, and my landlord's responsibility is the shell of the building, perhaps?
Yeah, the regs really dive into who owns what property, and depending on who has the burden, the benefits and burdens of ownership, that's going to really drive who is responsible for the upkeep and who pays for certain items like the build out of a space. And so if the lessee, the person who is renting out the space, builds out their tenant, their new office space, that is their unit of property, and much of the reg is dealing with units of property and who owns what. The lessor, the landlord might be paying for that, and then it's theirs. And so when you're looking at multi-tenant office spaces or things of that nature, you really do need to look at the different tenant spaces as a unit of property, and then determining what constitutes a repair and what has to get capitalized. And really for a tenant, if they redo the bathrooms and they only have 2 bathrooms in their space, but it's their space, the building has maybe 10 bathrooms, because it's their unit of property has been defined as their tenant space within the 4 walls that they're renting, they would have to capitalize those bathrooms. Now, conversely, though, if the landlord is sitting there and has put in the property and paid for the property, and and that person then pays for the 2 bathrooms, but then he's got 10 others, then he may be able to write that off. So it is very a facts and circumstance decision that needs to be applied in each case.
And you mentioned earlier that there's all sorts of examples in the regulations that help us clarify those, huh?
Yeah, I'd say there's over 125 or so different examples that help us, and that's really, there is no bright line test, there is no silver bullet per se, that we just have to take those examples and apply them to our current situations. So,
okay. Mike, you mentioned earlier Form 3115. What is a Form 3115?
That Form 3115 is used to change your accounting method. So on that form, you describe what your current method is and then the method that you are electing to go to. And that method really will be what's laid out in the regulations themselves. And there are designated numbers that are used to identify which particular method and component of these regulations that you're dealing with.
So there again, a 3115 is not something that I should be completing on my own. I should be finding some kind of professional to take care of that for me. Is that correct?
Yeah, we'd recommend that you work with a tax professional comfortable with that form, and also get some help in terms of computing what's called a 481 adjustment, which is really the catch-up deductions that you may have missed in the past, and what allows you to capture those deductions and report those in your tax return this year.
So these regulations sound quite favorable to any business that buys property. Is that safe to say?
I'd say that it is very favorable. There certainly is going to be cases where a taxpayer may be unfavorable, where maybe we're expensing too much, but by and large, many taxpayers have capitalized things in the past because GAAP has told them to go ahead and capitalize it. There's going to be a lot more book tax differences with items that are now considered a repair for tax purposes, that the GAAP will still maybe have you capitalize, and those items going forward would be a tax favorable item. So,
well, gentlemen, if I could just summarize, and you could maybe affirm for me what I've heard, there's a new set of regulations that cover tangible property, and that property is anything that is purchased or constructed. And those new rules have an application right for my 2014 tax return, which could be due, if we have a calendar year end, could be due March 15th, or if it's an extended return, we have until September 15th. Is that pretty accurate?
Yes, that is.
And I could be looking at significant deductions that could appear on my 2014 return.
Yes, this is an area that all taxpayers really should take a very close look at and determine where they're at relative to what they had been doing in the past.
Gentlemen, I thank you for your time today. Is there any final comments you'd like to add?
It's been a pleasure to be here with you today, Chad. I guess what I'd just like to add is, there's a lot of opportunity here, and it's important that all the businesses really take a close look at it. And if they need some assistance, please reach out and get that.
I second that, Mike, and certainly these rules help us with finding opportunities with items that we can now consider a repair and expense, but let's not overlook an opportunity to utilize cost segregation to go back and find other opportunities where we can break down buildings and increase deductions using depreciation.
Gentlemen, it's been a pleasure. Thank you for your time.